Today we're going to be discussing the tax implications of owning a rental home. Many individuals consider investing in rental property in hopes of generating rental income. However, there are many tax implications to consider before you invest. Individuals must take into consideration the expenses that come with ownership of a second home. These expenses include mortgage interest and real property taxes, advertising, utilities, maintenance, and depreciation expenses. The taxpayer's ability to deduct these expenses will depend on how they classify their second home. It can fall under three categories: residence with minimal rental use, a personal residence; residence with significant rental use, a vacation home; or a non-residence, which is considered a rental property. The classification of the home will depend on the taxpayer's personal use of the home during the taxable year. Taxpayers must be careful when determining their personal use of their rental home. The IRS has specific rules regarding renting to relatives of a taxpayer. Days that are rented to a taxpayer's relative could be considered personal use. A home is considered a residence with minimal rental use if the taxpayer utilizes a unit for personal use for at least 15 days, in addition to renting said unit for 14 days or less. Taxpayers should know that there are benefits and disadvantages for classifying their unit as a residence with minimal rental use. Taxpayers can classify their residence within this category if they wish to make some quick cash. Any rental income that is generated can be excluded from the income on their tax return. For example, a taxpayer who lives on a beachfront property has the opportunity to rent his home for a week while he travels out of state. With such a desirable location, he can charge a fair rental value and make a quick buck without having to report it on his tax return. However, one of the disadvantages of classifying your residence within this category is that no expenses may be deducted. The second option taxpayers have is to categorize their home as a residence with significant rental use. This is when a unit is rented out for at least 15 days, while personal use is the greater of either 14 days or 10% of the total rental days. In this case, rental income must be included in taxpayers' taxable income. But taxpayers also have the ability to deduct some of the expenses that are synonymous with renting out a home. Expenses are allocated to the taxpayer's personal and rental use of the home accordingly. Expenses allocated to personal use of the home are non-deductible under tax laws regarding rental homes. Finally, taxpayers can categorize their second home as a non-residence. In this case, the home is rented for at least 1 day, while the personal use of the home does not exceed the greater of either 14 days or 10% of the total rental days. Much like residences with significant rental use, non-residences include all rental income on their tax return and allocate expenses to personal and rental use. Taxpayers who categorize their home as non-residences are also subject to passive activity rules. Passive income and passive losses. According to the IRS, any rental activities are considered passive activities. This means that taxpayers who are involved in the trade or business of renting are considered not material participants. Unfortunately, there are limitations on how to utilize passive losses. Passive losses are not allowed to offset any income generated by a non-passive activity. They may only be used to offset income generated from other passive activities. However, renters who are active participants in the renting of their properties are allowed to deduct up to $25,000 in rental losses. This amount is subject to a phase-out. While the IRS defines any rental activity as passive, there are specific exceptions that renters should be aware of. Code Section 469, subsection C, paragraph 7, clause 1, defines taxpayers who are an exception to this rule. This section defines these taxpayers as taxpayers who are involved in more than one-half of the personal services performed in trades or business in which the taxpayer materially participates, and Clause 2 performs more than 750 hours of services during the taxable year in real property trades or business in which the taxpayer materially participates.
All right, today I'm going to go over what I think the top 10 deductions are for owning a rental property. My number one deduction is going to be interest. Interest is often a landlord's single biggest deductible expense. Common examples of interest that landlords can deduct include the mortgage interest payments on loans that are used to acquire the rental property or even improve the rental property itself. Also, interest on credit cards for goods and services that go towards the rental activity can also be deducted. Then my number two deduction is depreciation. The actual cost of a house an apartment building, or any other sort of rental property is not fully deductible in the year in which you acquire it. Instead, landlords get back the cost of real estate through depreciation. This involves deducting a portion of cost of the property over multiple years. My number 3 deduction is going to repairs. Repairs of rental property, which in mind must be ordinary, necessary, and also reasonable to a certain amount, are fully deductible in the year that they are incurred. A good example of a repair would be something as simple as repainting a home, fixing the gutters or maybe floors, and then also fixing any leaks, plastering, and broken windows that may have taken place. Now, you must keep in mind that there is going to be another deduction later on that you may also be able to qualify replacing a broken window. So let's keep that in mind. My number 4 deduction is going to be local travel. Now, this is something that I don't think enough taxpayers are fully informed on. Landlords are entitled to a tax deduction whenever they drive anywhere for the rental property. That could be as simple as going to a grocery store and picking up a light bulb. If you drive there, you are able to fully deduct that gas that you are using as long as it's for the rental property. But keep that in mind, that does allow you and the IRS to have a little bit of ambiguity when going about, did you really go to the store in order to increase your rental property, or did you go to the store to buy yourself groceries for home? As long as you can have the receipts to back up your transactions and make sure it's purely for rental activity, you should have no problem with supporting your facts to the IRS. Now, as I said, you can actually deduct the actual gas expense, the gasoline, or the upkeep or any repairs to your vehicle, or you can apply for the standard mileage rate. And for the current year of 2014, that's going to be 56 cents per mile. My number 5 deduction is going to be long distance travel. If you travel overnight or a set of multiple days, but it's for your rental property, you can deduct your airfare, your gas, hotel, meals, any other kind of bills or any expenses as long as it's toward the rental activity. If you plan your trip carefully, you can even mix in a little bit of fun along with the business aspect. However, this is where the IRS is very strict on some of these deductions, and in most cases, the taxpayer is going to claim that, I did this trip, it was for my rental activity. However, they have no receipts, they have no facts backing that up. And if you have the proper documentation of doing this, the IRS has no way around it but to grant it because you have the documentation to back it up. Let's say you go on a trip for 4 days for some rental activity and you stay a 5th day. As long as you can market that you were there for 4 days strictly on business activity, you have no problem getting by. Now, my number 6 deduction is a little bit of a curveball. You can actually deduct a home office. Now, provided they meet certain minimum requirements, and also landlords may deduct their home office expenses from their taxable income. This deduction applies not only to space devoted to office work, but also to a workshop or any other home workspace you use for your rental business. This is true whether you own the home you're currently living in, own the apartment, or even if you're merely a renter, you are able to deduct your home office with proper documentation. My number 7 deduction is employees and independent contractors. Whenever you hire anyone to perform services for your rental activity, you can deduct their wages as a rental business expense. And for example, let's say you currently live 200 miles away from a rental property that you own, and you're not able to go there and fix what's damaged. If you hire a plumber, an electrician, or something to that extent, their wages are fully deductible. My number 8 deduction is casualty and theft losses. If your rental property is damaged or destroyed from a sudden event, such as a fire or a flood, you may be able to obtain a tax deduction for all or part of your loss. These types of losses are also called casualty losses. You usually won't be able to deduct the entire cost of the property damaged or destroyed by a casualty. How much you may deduct purely depends on how much your property was destroyed and whether that loss was covered by insurance. And that's a great segue to my number 9 deduction, which is insurance. You can deduct the premiums you pay for almost any insurance. That can be as simple as fire, theft, or flood, or even extraterrestrial, our good old friends aliens from the Mars. But anyways, and if you have employees, you can deduct their health and workers' compensation insurance as well. Just keep that in mind. And my number 10 and final deduction are legal and professional services. You can deduct fees that you pay to attorneys, accountants, property management companies, real estate investment advisors, and any other sort of professionals. As long as these professionals are strictly for your rental activity, they are deductible. So just keep that in mind when you're going about your business and tax returns are due.
Good records will help you monitor the progress of your rental property. Prepare your financial statements, identify the source of receipts, and keep track of all your deductible expenses. It will also help you prepare your tax returns and support items in case of an audit. Maintaining good records relating to your rental activities is key. You must be able to document this information. Be sure to keep track of any travel expenses you incur for your rental property repairs. Separate receipts for minor repairs like plumbing, fixing a broken door, and also keep your receipts separate from capital improvements such as a new roof. You must be able to substantiate certain elements of the expenses you deduct. You generally must have documentary evidence and along with a receipt and any bills that support that your expenses actually were incurred. If you are audited and you can't provide support for the items reported on your tax return, you will face additional taxes and penalties. I'll be telling you about a proper rental expense spreadsheet. So the keys to a good rental expense spreadsheet. As you can see, this one looks pretty complex. It is important to be thorough when making your spreadsheets. As you can see, it is easy to let the months pile up and lose track of all your expenses. Here we have lots of expenses listed such as insurance, interest, cable, telephone, etc. All these are kept account for on a monthly basis. A proper spreadsheet should provide you with all your expenses, and that way you can estimate your correct gross income. It is important to keep track of all these expenses in case you are ever audited, and therefore it is also important to keep receipts for all these transactions that you keep track of.